So how does the 10-year treasury note yield impact mortgage rates? And so what you just talked about, how does that affect the treasury note
For
yield?
sure. Yeah. So the 10-year note essentially is a great indicator of what the market's doing, because again, as we have the stock market on one side, we have mortgage rates, and mortgage backed securities are harder to kind of look up per se, like a stock price, you simply just put in the ticker, you see the symbol. Well, that's where the 10-year note helps out because that's in that similar category of a bond, or a US Treasury note. So those fall in a similar category for investors as mortgage backed securities do. So for example, so many folks in our industry look, if the 10-year treasury note is down,
Mhm.
that correlates very, very closely with mortgage rates and vice versa. So again, as we look at it, like rates kind of peaked at the top around October 18th of last year. And the 10-year note was ticking right around 5% or, 4.99. Well, even by December, the pretty significant drive down, the 10-year note got below 4%, like in the 3.8 range. And it's up a tiny bit this year, but that was a big factor, that showed a correlation with interest rates coming down too. So I wouldn't necessarily say the 10-year note directly controls rates, but it's a very good correlation for us to be able to see, hey, as that drives down, rates are in correlation with it. Vice versa, as that goes up, rates are correlating upwards as well for us.
So that would be a leading indicator, basically, is what you,
Absolutely. Yeah.
yeah.